Hello and welcome to the Tracer Franchising Podcast. This is a podcast where we talk to franchisees and franchisors to learn what might be a great fit for you and to get smart on the franchising industry. Today, I've got Jacob Lee, who's kind of interesting. He's on both sides in a way. He's on the franchisee side, and he's on the vendor side. Has a lending business. Interesting background, so I'm excited to get into it. Thanks for being here, Jacob.
Of course, looking forward to it.
Awesome, man. So yeah, just let's start with you, right? So tell us a little bit about you and your background and what kind of led you to where you are today.
Sure, awesome. Well, I'll go back. I grew up on a farm in Middle Tennessee. My family has a history of entrepreneurship. My great grandfather started a business in the 40s, and so I think I always had in my head running your own business is kind of the goal. Maybe if I didn't have words for it, that's kind of what was in my head. And so went to Auburn University undergrad, studied engineering, worked as an engineer in the nuclear power industry right out of college. And it was a great experience, but definitely didn't want to be in a cubicle being an engineer. My whole career wasn't really what I was cut out for. So went back to school for my MBA in 2016. From there, went and worked in management consulting at a firm called BCG. And again, great experience. Got to meet a bunch of great people, work in 6 or 8 different industries. And I think, people ask was that experience at all relevant for what you're doing now? I'd say not directly. Obviously, kind of PowerPoint, Excel presentation was my world then, and now it's more small business stuff. But I'd say like indirectly, the skill set of having to kind of get dropped into an industry or a business that you don't know much about and get up to speed really quickly and triage and like figure out what the levers are to pull and how to solve problems. I think that's a skill set that I learned there that has become incredibly useful where I am now. So I did that for 3 years, left in 2021. And my business partner at the time was in New York. He was doing investment banking. He quit his job. He moved back to Birmingham, where I was, Birmingham, Alabama. And we spent a bit of time looking for an existing business to buy and put a pause on kind of the search to explore this world of franchise. And at the time, I didn't really know anyone who was a franchisee, but we had a couple of people that we really thought highly of that suggested that we look into different franchises. And one of the early brands that got me excited was Orange Theory Fitness. And at the time, Orange Theory was kind of on a tear. It was, right before COVID, and I guess it was kind of going into COVID. But you could build an Orange Theory Fitness for $400K, and the FDD showed average earnings of $200K, and that kind of model of multi-unit brick and mortar was really appealing, and that's kind of what we went out to look for. So ended up signing on with Scent Hound in 2021, initially with a 10-unit agreement, and have since expanded to 20-unit agreement. We just opened our 8th location in November, and we've got number 9 under construction. So it's been a great journey.
Very
That's
cool,
kind of
man.
the 2-minute version.
Yeah. So let's kind of like unpack it a lot here, right? So you start off with a search, right? I'm actually working with a couple guys now who did the exact same thing, right? I think that's kind of what is like sexy right now, right? And because there's so much, there's just a lot of froth, right? So there's a lot of competition. So like what kind of made you pause besides, this one guy that you knew kind of said, hey, you should look at franchising and say like, you know what, maybe it's worth giving up, 8% of the revenue for this as opposed to continuing our search for the full. Usually, people search for like 2 years, right? So like what was the deciding factor there?
I think it was probably not, it was kind of like a progression, but I'd say one of the things that scared me about the search was we met a guy in Birmingham that went to the same business school that we went to that was probably better connected than we were in town, and knew all the people, and had been searching for 2 years and hadn't gotten a deal done. And we were about to start on this journey, and then like just a few of these sorts of conversations um sort of scared me into the possibility of spending 2 years of my life, you know, and then we were going to do a self-funded search, so spending 2 years unpaid, and then not close a deal that seemed like a pretty high probability, or not a a potential, and that risk was a bit scary. So the beauty of franchise is you have these franchisors that are selling you, and so then it's like, the risk of not getting a deal done is lower. The probability of getting landing in a high quality franchise is another consideration, but I think
Yeah.
that was probably the biggest driver, honestly.
Yep. Yep. So just the pretty much ability to get to a close. And I think I hear that a lot with geographically constrained searchers, right?
Mhm.
Is that the only people I've really heard that did that successfully were in like New York City, where there's like a million businesses anyway, right? But it's like really hard to find businesses in your sweet spot locally in a short amount of time, right? Whereas with a franchise, you just check to see if the territory is available, and if it's the available and it's a good franchise, you can move forward. Um, okay. And so you started with Orange Theory. Well, let's back up a little bit. So you and your business partner, and you went to UVA for business school, right?
Mhm.
Yeah, you're being modest there, right? So UVA is like an amazing business school. So so you and your partner are looking, um and you go decide to go on the franchising route. Like, what is that? I imagine you guys had some sort of thesis, some sort of model, right? You said a little bit Orange Theory, but like that's not a real thesis, right? Like, what was the driving thing that you guys were looking for as you started your search in the franchising space?
Um, I'll tell you a few things that kind of became our criteria. So, one, backing up to, search versus startup franchise, because I think there's this other path, which is like franchise acquisition, which is kind of the same thing as search to me. But like startup franchise, you're not really buying a business, you're starting a business with a template. Um, and I think another appealing thing was like, as a first time business owner and first time manager, I'd never managed anybody before. Like, kind of starting small instead of going and buying some landscape business with 50 employees and thrown in the deep end with a $4 million loan, that you have to service. Like, starting with one Scent Hound, hiring employee number one as a store manager, taking out a like $250,000 loan, to get that store up and running, and then like figuring things out. I think for me felt a lot. It felt like a natural progression instead of just kind of going from, I was an individual contributor as an engineer, as a management consultant. I went to business school, and now I'm running a mid-sized business with 50 employees and a pretty big debt load. That was a little bit scarier. So I think that was appealing. That I'd say from like the thesis, I think,
Well, let's hold on real quick. I got a question on that, right? So
sure.
because I get this all the time. They're like, I can't get over the fact that it doesn't have revenue, right? It feels riskier. It feels riskier than because there's nothing there, right? There's just a
Mhm.
template. Um, so I have two questions. One is, how did you kind of get over that fear, right? Like, hey, I wanted to start with something, and now I'm starting with nothing but a playbook. And then two, you know, you can buy a franchise that's doing 100 grand, right? Like, there's a million of those out there. It's just it's not super attractive because when you add debt, it's really doing like 40 grand, right? But they're out there, and so it's a little bit faster than having to wait for a build out and all this other stuff. So first, like, how did you get over the fear of no revenue, and then what made you choose to go from the ground up as opposed to find a small acquisition?
Um, I don't think fear of revenue was a problem for me. I guess it's more when I looked at Scenthound, let's like take an example. I thought, well, dog grooming has demand, and th- there are lots of people in Birmingham that have a dog that need to get groomed. That's not a problem. And if this model is working in other parts of the country with similar demographics as mine, then and if the people that are running those businesses don't have any sort of special sauce that I don't think I can like, then made me feel good that we could replicate that in Birmingham. So, but your first store is a test. Like, you're opening the store and seeing how it goes. And I think if we had opened one Scent Hound and it went poorly, it would have been um we probably would have tried to hit the brakes. But the nice thing is you're only in it for a few months of your time, a year of your time, and a smaller outlay capital instead of like some kind of search. So I think not having revenue, um, I think it may be risky if you had a big amount of investment in the business, but if you don't have a lot of debt on the business, I don't think it's considerable risk.
Right.
Um, what was the second part of your question?
How come you didn't look to buy a franchise that was just smaller, right? Smaller than the
I
normal ETA crowd.
I think if there was an opportunity to buy an existing franchisee that was scaled and in an attractive franchise, I think we certainly would have been excited to look at that. But at the time, I didn't know anyone who was in franchising. We didn't have any track record. So a lot of these established franchisors that you'd want to be a part of their system are not really interested in selling a successful franchise to a first time operator. And so I think it was kind of a matter of access and like, I think buying a single unit doesn't necessarily give you a big head start to just starting from scratch. Um, and so I think for those reasons we were looking for an emerging brand that had available territory in the region of the country that we wanted to build in, and that was in a really attractive industry.
Okay. So, I mean, I guess that was your criteria, right? So how did you define like a attractive industry, right? Like most searchers are like B2B, recurring, contractually recurring revenue, needed business, right? It's like those things. And now we're doing like dog grooming, right? Like if Fido doesn't get his haircut for 6 months, it's not, my house isn't going to burn down, right? So like, how did you go from that to dog grooming?
I think that one, I like just sort of the unit economics of these brick and mortar franchise businesses where you can get the business up and running, you lease the space, you do a light tenant build out of the space, you buy some equipment. And so like for Scenthound, all in about 400K. And then you can look at the FDD, you can look at the item 19 and see like what did the average franchisee do on financial performance. And so I think that was one of our big filters, was just like, what's the return on invested capital? Is it greater than, let's say, 25%? Um, and then you get to a small set of franchise brands. Okay, does this franchise brand have available territory so that we could build at least, enough stores to get to $1 million of EBITDA? It might be a great looking franchise, but if we're too late to sign on as a franchisee, then they may only have one license available in Anniston, Alabama. That's not going to be big enough to support me and my partner at the time. Um, and I think with dog grooming, it's an industry that has really good secular tailwinds. So um, the rate of dog ownership over time has been steadily growing. More than half of American households own a dog. And then spend per pet has also been growing. So these are trends that have been going on a long time and have they don't look like they're slowing down. And I also think that the grooming niche within pet services is fairly underserved. There's a lot of strong competition in big box retail, in boarding and daycare, but facilities that focus on the grooming aspect are under there's not as many competitors. And part of it's because it's a tough business to run, but yeah, I think for those reasons we liked the industry, and it was pretty early, there were only about 15 or so stores open when we signed on, so it's always kind of a gamble on, and the numbers that they represent in FTD at that stage are kind of like a best guess. There's not a ton of data, not a lot of track record. But we liked and we also felt good about the franchisees that we met early on, and some of the kind of indicators of the quality of the franchisor. So
Awesome.
it's
Awesome.
an art, not a science.
Yeah. Yeah. And I'm more on like the lower risk, I think, end of things, and 15 to me isn't proven enough, right? But like you got comfortable with it, so that's cool. Um, okay, so let's back up a little bit, right? So because you said it started with Orange Theory, right? So like, how many franchises did you go through, like before you got to what you liked, and like, what did that whole process look like?
So it looked like my partner and I were in my backyard shed, which is my home office, and we would meet every day, and we would sit, and we had a big whiteboard, and we like would comb through these lists like franchise times, and we'd go through the Wisconsin repository at FTDs and talk about these different brands, and then like do some desktop research on different brands. And then we had like a whiteboard of um 6 or 8 different criteria, and if we if we were interested enough, then we would reach out to the Frandev department and start in their sales process. And then we probably made it to the discovery day of maybe 6 brands.
Wow,
Um,
you
and
physically went to 6 discovery days.
well, they were all via Zoom at the time because of COVID. So
Oh,
it was a pretty efficient way to go discovery days. Um, but yeah, we probably looked at like 100 brands with some level of rigor, and then whittled it down to half a dozen or so that we were seriously considering, and ended up, and Scenthound was one that a colleague of mine at the consulting firm I worked for was the franchisee in Charleston, South Carolina, and we were just catching up, and kind of like one thing led to the next, and um, I'm glad we landed on Scenthound.
yeah, yeah, very cool. Okay, so like, um, when you guys were doing research, what are kind of tips and tricks you picked up? And I gotta plug myself here. I got a free app for people who are doing their own research, right? App.tracerfranchising.com. You never have to talk to me, and I'll walk you through how I do my research. It's got videos, it's got questions to ask. You can store the answers, and you can compare the answers across franchises to see everything in one place. So I have to plug that real quick.
Love it.
But what what are you what'd you guys learn through the process of like, okay, at franchise number 50, you probably had like a couple of questions that really got you to a yes or a no quickly, right? It's like, what did that kind of look like?
Yeah, well, I think the first thing was like looking at the item 19 of the FDD, and if they didn't represent anything, it's just really hard. That's part of the value prop of being a franchisee, is being able to look at the past performance of other franchisees to help make your decision. And so the brands that didn't represent anything or it was pretty sparse in the item 19, it was hard for us to really proceed with those unless we had some other really strong validator, like we had some inside knowledge of a franchisee that was doing really well.
Yeah.
But I
Yeah.
think looking at the FED and the 19 compared to the item 7, which is the total investment.
Yeah.
And so uh, the list gets pretty short if you are looking for brick and mortar franchise concepts that have like greater than 25% return on investment. And so that like really helps whittle it down. And then
So were you using like medium? Because they always have like thirds or quarters or whatever, right? what were you using as your item 7? And the item 7 has, like, a high and a low, right? So were you, like, going middle item 7, middle item 19? Is that what you were kinda doing for your assessment?
Um, I think this was back then. I'm not exactly sure. What I would do now is I would look at the high end of the item 7 because I think that's like the realistic investment.
Yeah,
I don't know.
yeah.
I think the low end is just like, oh, we had some franchisee that was able to buy the building from his cousin, and so it was like half the normal price. Um, I'd say the high end of that item 7, and then the FDD. I do think like it's very useful to look at the bottom quartile, the top quartile, and the median. Um, and so I think we look at the median as our kind of base case. But I also think that franchisors, they have to disclose this thing, and it's not that the numbers are inaccurate, but they're going to try and present the numbers in a way that makes their franchise look good. If
Yep.
if they have to survey all their franchisees, they're going to survey them in a way that presents the data in a positive light. So I think just keeping that in mind when you're looking at these numbers. But yeah, I think the main point is just like try and be consistent, as consistent as possible between two different brands you're looking at, so that you can compare apples to apples. Although that's not always possible, but
Yeah. Yep. I think the one other note that you kinda hit on, but I just wanna, really highlight it, is that if the item 19 isn't like, "Here's revenue," right? Like, "Here are the actual numbers." Like, I've seen item 19s where it's like the number of ice cream cones we sold. It's like, "We sold
hmm
1,000 ice cream cones." It's like, "Dude, what does that mean?" You know, it means
hmm
nothing. Um,
hmm
and so, like, whenever they start getting, a little fancy with the item 19, it's usually because the numbers that aren't good, right? And that just, to
yeah,
me, is like an immediate pass, right?
yeah, yeah. And sometimes you'll hear franchisors saying, "Oh, like we don't need to share. We don't want to disclose. We don't need to share. We got plenty of demand." I don't know. I think all the great franchises that I've encountered have really detailed FTD item 19s. I'm sure there's exceptions to that rule, but most of them have, because they want to show it's part of their marketing. They want to show how great their franchisees are doing,
Yep.
to attract as many possible new ones.
Yep, yep. Agreed, agreed. Okay, great. So, you got this short list, you used the 25% return, and then you started talking to franchisees and franchisors, right? Um, you pulled Scenthound, and so did you sign for 10 off the bat?
Yeah, we signed for 10 off the bat.
Okay, and so, yeah, I guess you paid for all 10 franchise fees and then whatever the startup cost for the first one was. Is that how it went?
Yeah. Um, I honestly don't remember exactly how it went, but that sounds right.
Yeah. And then so you got the first one going. How long did it take to open it? How long until you felt comfortable opening number 2? Like, kinda go through this development schedule with us.
So we signed in July. We opened our first store in February of 2022. We opened our second store in November of 2022, and then a third store in April of 23. So, the first store, so like you sign a multi-unit development agreement, you sign the franchise agreement for the first store. We went and found a broker, and like I leaned a lot on my father-in-law, who's a businessman, and kind of mentor of mine in Birmingham, and he helped connect me with like a local broker, attorney, CPA, bookkeeper, help kind of get everything up and running. And Scenthound at the time, it's a pretty new franchise, so a lot of these capabilities are underdeveloped probably. And they since probably have. I haven't been through the new franchisee process in a while, but I think they've got vendors for a lot of these things now. But um, we go and we start looking at sites. We submit LOIs. Um, Birmingham is just. I think one thing that I underappreciated being a franchisee is like, um, the variable of real estate. Like if it's a brick and mortar franchise and you've got to go find a space to lease, and if you're really particular about finding a really good space like I am, then it can be an easy, quick thing if there's vacancy in your submarket, or it can be a very long, painful, drawn out process. And so like in Birmingham, our first store, we had 3 spaces we looked at. We submitted LOIs for all 3. We picked the best one, and we had a lease signed in like a, a month or 2. Um, in Nashville, we spent 12 months between stores. And I think we submitted like 12 LOIs,
Wow.
and finally got a lease signed. But like, there's just so much that's out of your control, and it's so dependent on like kind of the demand and the availability of space in your market. Um, so kind of back to the first store, we get an SBA loan. We go hire our first employee, hire the team, do training, launch in February, and kind of learning all this stuff for the first time as we go.
Yeah. Yep. Yep. Okay. And then, um, now I'm someone who wants to know what it's like to buy 10, right? So like what was your day job? Like what did you do day to day? Store 1, store 2, store 9, right?
Yeah, so I think it's evolved. So store 1, like before we open, we do pre-sale. We start running ads on Facebook, and um, we would get a lead that came through, phone number, name, email, and I was picking up the phone and calling the lead, leaving a voicemail, making notes on a spreadsheet, and like managing this whole pre-sale process. Um, I was doing kind of like everything on the loan, the store, managing the build out, all that, everything that a first time franchisee does. And then over time, like store, the first hire was Bobby, was the manager of our first store, and then he kind of backfilled his role, hoped to open the second store, helped open the third store, and then now he's overseeing the 4 Birmingham area stores. And then we did something similar in Nashville. We hired Kelly, and when we hired Kelly, she kind of immediately went into this area manager role, and so now over the past 4 years, it's kind of evolved from me being in the in the weeds of every process to more like trying to replace myself in these processes and delegate things um, to area managers. My father-in-law that I mentioned is now working as a development manager, so he manages everything from the lease sign to store opening. So he manages all the like equipment procurement, build out process, managing the GC. Um, so yeah, it's evolved, and now I feel like my job is more process improvement, making the business better. So I have these big initiatives that um I'll take on. Like last year, I took on this initiative to do improve benefits in HR. And so that's like a big you don't realize how big of a process that is until you get into it. But that's kind of my role, is process improvement and just being the leader to Bobby and Kelly and our business development team manager Lily.
Cool, cool. So how many dogs have you groomed?
I have washed a few dogs. I could not give a dog a haircut. You wouldn't want to see a dog after I gave it a haircut.
Nice. So you never were really truly in the business, which is really cool, right? So, and it sounds let's go talk about the team that's helped you do this, right? So you had a partner, or you have a partner. I'm not sure you've like referred him as your past partner. Um, and you have your dad who sounds, or father-in-law, sorry, who's helping out. Like, if you're coaching someone who wants to do the same thing, 10, 20 locations, what's the team they need to be able to do this, or could they do it by themselves?
Yeah. So yeah, and my partner was in the business full time for the first year or so, and then we kind of realized that it was going to be a while until both of us had a job, that could support us. And so like he went back and got a full time job, and it worked out great. But I'd say the needs of the business evolve, and I think you sort of have to think about um, what what do I want to be as a franchisee? Do I want to be There's different models of being a franchisee. I think there's the model of I manage one store, I'm the store manager. And by the way, if you have a high performing store, that can be an awesome job. If you love being involved in the community and being a shop owner, like it can be a very high paid and great fulfilling job, you know? Um, that's one model. I think the other model would be like franchisee as area manager. And so you have general managers and maybe you have like 3 to 5 or 3 to 7 stores, and you have weekly meetings with your GMs. You do all the like bookkeeping and administrative work. You make the schedule for the employees, like you're the area manager. And then maybe like a third model, and these are not clear cut, but this is like I think generally true. And then the third model might be like franchisee as the CEO, for lack of a better word. And that would be like the area manager is managing the managers. And so they're really managing like Bobby and Kelly are really managing the day-to-day operation of the existing business. And then my job is more focused on picking new sites for new stores, like managing what do we need to build to take the business to the next level. And like, for example, we now have Tom, that I mentioned, is kind of helping drive the construction process. That was my full-time job for a while. Like that requires a ton of work, especially if you're building a couple, 2 or 3 stores a year. And then this other team we've stood up is this like call center team that manages all of the phone call, text, and email with all of our existing customers and potential new customers. Um, and so, yeah, I think and I think the natural progression is for franchisees to kind of start in stage one and then move through. But it takes it takes some time. It's not an overnight journey. It takes some time to get to the stage of like the business works without you.
Yeah, yeah. It takes, I feel like there's also a decision of, and you kind of hit on a little bit with your partner of like capital, right? So like, am I going to pay
Mhm.
myself or I'm going to put more towards growth? Or maybe I have it all saved up, so there is some amount that's coming in for some reason, or right. Like, how did you think through that? And like, how are you making the trade off between I'm going to do 3 stores and pay myself something, or I'm going to do 4 stores this year, right? And just buy another, sign another lease and put another deposit down. Like, how'd you work through that from the beginning, and how has that viewpoint changed as you've gone through the last 4 or 5 years?
Yeah, I think that's really important thing to consider is that um, if if I had decided to not hire like all this extra overhead, all the non-store, I think that the FTD is based on are the what's the P&L of a store, and that's usually like a general manager and a team beneath them. But like area manager, business like new store development manager, call center team, that's not in the FTD. And so those things are and like for us, like we have the team right now, we have 8 stores open. But the team we have right now is the team that I hope we have when we have 20 stores open. And so you're having to like make these investments in the team and in the structure well in advance of when you actually need it. And that's expensive. And so, and it takes time. We're like coming up on 5 years in and just now kind of getting to this scale where the infrastructure is built. And so, yeah, I think it's it's easier when it's easier to make those decisions when the business is going well and the early stores have a lot of traction and you have a lot of conviction that this could be a great business. When you have a store that you open and it doesn't do as well, or it's like a little bit weaker, that's when the decision gets tougher. You have to decide, am I going to like sign on for another personally guaranteed SBA loan? Am I going to sign on for another 10-year personally guaranteed lease and just kind of keep going? Or am I going to like hit pause? But hitting pause can be risky too, because then you're stuck with 3 stores. And if one of the three is not great, then 1/3 of your stores is not great. Whereas if you have 10 stores, if one is not great, it like, I do think that the risk of the enterprise goes down as you open more stores. So yeah, it's a it's an interesting journey.
Yeah. Yeah, it is. Um, okay. And so you have Birmingham and Nashville. What other cities do you have?
Birmingham Metro, Nashville Metro, Huntsville, Alabama,
Yep.
Chattanooga, Tennessee, and Tuscaloosa, Alabama.
Okay. So is your partner up in Tennessee? Is that why you chose that market?
I am from Tennessee. And so like when we originally signed on, we were kind of looking for a territory large enough to support 10 units, and Nashville's a great growing market. And so, and it's not too far a drive, 3 hours from Birmingham.
How often do you have to go?
I go about once a month. I'd
Oh, yeah.
say, and it depends on if I'm looking for new sites actively, I might go up more than that. But when I go to visit, it's mostly just to visit, just to like have some FaceTime. Um, but yeah, probably about once a month.
Yeah. Yeah, that's really good. Was it more when you were first getting going?
It was more when I was first getting going, and I think a lot of it has to do with like, we hired Kelly. She was with Red Lobster for 30 years or so before, and was a multi-unit manager for them. And so she's got a ton of great experience, and like, but she had to kind of get to know Scent Hound and figure out how to run a Scent Hound. And I think once she got her legs under her, and we kind of had that like trust, then it was pretty easy to step back for weeks at a time and let her do her thing. And her and Bobby are both way better at their jobs than I could be. They're both like really good at hiring and managing their teams and building a team. And so I let them kind of like, I try to give them free reign to run and build the culture within their own business. And I try to make their job easier by supporting them with really good tools and systems to make sure we do a great job.
Awesome. Awesome. And so how much do you think value you're getting from the franchisor year 1, year 2 versus now?
Great question. I think as a new franchisee, if you think about it, like I had never been in the dog grooming business, never been a business owner, didn't know anything about anything. And so I think you're getting a ton of value for the first store. And then the second store, I think you had just done it, and you kind of know the drill to some extent. And so I think as time goes on, it's not as much about like, how do you open a scent hound? How do you run a scent hound? And then it's more about like, as Scent Hound gets to 150, 200 units open, you get to borrow the brand that they've built nationally. And so if somebody moves to Nashville from Dallas, they might have been a member of Scent Hound in Dallas, and that becomes a really valuable asset. So I think the value changes a bit, because at the beginning, when there's 20 stores open, like there's no national brand equity. So, um, and I do think that as time goes on and their royalty revenue gets bigger, like they're able to attract the best and brightest, and like build out some really good new services, technology tools, things like that that make our business better.
Very cool. Very cool. And I mean, you have to have conviction that they're going to grow, right? So what kind of gave you that confidence that these guys weren't going to stall at 30 units, 40 units, 50 units?
Right around when we signed on as franchisees, Dave Long, who was the one of the co-founders of Orange Theory Fitness, became a board member of Scenthound,
Mm,
and they took a growth equity investment from a private equity firm. And so those were just like good positive indicators that um, these people that know a ton more about franchising than we do saw something attractive in Scenthound. That maybe there's something there, and they just had some really strong early franchisees. And so, yeah, I think the the way I thought about it then was dog grooming is a great business. We could have a successful dog grooming business even if the brand does not grow and take off. If it does grow and take off, then that's great. But we could still succeed as franchisees even if it's sold at 30 units.
okay, cool. All right, and then kind of to wrap things up, I got two more questions around kind of like big picture here, right? So, you originally were looking at a search fund, self-funded search. Do you think, and people do that because they're attracted to the outcomes that are possible, right? Even though those outcomes are relatively rare. Um, do you think this outcome, if you had found the perfect business when you were searching, right? Do you think you're creating a comparable outcome with through Scenthound that you would with the same investment if you had found, whatever hit your boxes on the search?
I do. I think I might go a step further and say it would be hard to probably have a similar outcome in a self-funded search, just because um our one we've the investment, we use SBA loans to finance the first 5 stores, and so like as a self-funded franchisee, it's not a lot of equity investment up front to get a store up and running. And the loans that we've taken have basically financed all the growth since our original investment. And so, and I do think that most self-funded search type businesses don't have really high reinvestment opportunity. What I mean is like you might have a landscape business that you could grow organically in your town, but like going and opening a new office is less straightforward than with a franchise. With a franchise, a multi-unit franchise model like Scenthound, you can take the earnings of store one, go open store two with an SBA loan, and you have a really high return on investment. And so, and I think there's also um, the runway is big. I think especially with a business like dog grooming, um, there's no lack of demand for our service throughout the state of Alabama and the state of Tennessee. And so I think building a scale business in some ways is easier than your typical self-funded search business. So
Okay.
I mean
Um,
there's always pros and cons, but I'm really thankful I chose this path.
Awesome. Awesome. And so you're saying that the initial equity is all that you personally put in. The rest of it came from the other stores.
Um That's not 100% true, but mostly true. Most of the equity was from that original investment in 2021.
Okay. And then when did you start paying yourself?
Well, that's kind of an interesting question because like I don't take cash out of the business. Like I keep and I'm kind of a unique situation. Like I've got the ability to pay my bills from other income. And so I do think that provided me a big advantage along the way, being able to keep cash in the business and fund. And so like most of the cash generated from the business stays in the business in the form of equity in the next store. So um yeah, so I'm continuing to reinvest in the business and plan to do that for quite some time.
Yeah. I think sets good expectations, right? Because, people will say, "Oh, I want to get to to stores, but I need to replace my income in 3 years. And it's like, well, if it takes you 4 years to get to 5 stores, you might not pull anything out until you've opened all those stores and they've gotten stabilized.
Yeah, and I
Otherwise,
think it's
yeah,
also the stabilized point because, you might hit your revenue target really quickly, but you tend to hit a revenue target before you hit your, like, margin and EBITDA targets because, like, for us, we're really keen on a great customer experience for the first 12 months that we have a new store, and that typically means, like, making sure the stores are really well staffed. And to make sure they're really well staffed, your labor number is really high. Oh, and by the way, like with a new store, you have a new team. A new team means lots of turnover. And so like we've really seen like 18 to 24 months after the store open is when you start to at least in our business, start to like stabilize EBITDA margin and see the reward. So yeah, it might take you a few years to get those stores open and then a few more years to get them stabilized on earnings. So I do think that that's one of the challenges in franchising is you have these franchise development departments that are trying to sell licenses. And so they're going to try and create, this vision of what it could be. Um, and then you have people that, that get these expectations of how quickly it's going to take. And sometimes those don't match reality.
yep, yep. I think a lot of franchising is built on you being the free labor for a while, whether it's management labor, right? Because that could be $80,000, right? Or
Right.
even sometimes doing the job. Um, and it's I was never good. I don't have an MBA, right? But there's these online courses you can take in relatively short amount of time to get pretty good at financial modeling. And I recommend people to do that because if your model says one thing and the franchise development guy says another, your model is probably right. Especially if you've talked to 10 franchisees and they've all told you that it's right.
Mhm.
Um, so I would agree on that. Okay. And then last question for you on this before we move on to the SBA business is the other thing that I hear, especially from guys with, MBAs like yours, with consulting, right, is that it's a little ego, right? It's like I go to a cocktail party with a bunch of other guys from McKinsey or BCG or whatever, and they're telling me about some $1 billion, consulting project they're in charge of, and this one tells me about a VC backed startup, and I got to tell them that I own a dog grooming franchise, right? How did you? I don't know if was that an issue for you, and how are you kind of getting over it when you do have those conversations?
Um, I think it's really funny because I go to these parties and people are like, "Oh, so what do you do?" And I'm like, "Oh, I own a dog grooming business." And a lot of people think I'm like, you know, grooming dogs every day, which is like not a normal career path. And so, but I honestly think it's I think I never really had a problem with it. I think it's kind of like the best kept secret is that you can live like I think franchising or business ownership, small business ownership in general is such a great lifestyle. And I think when you realize that you can have full control of your schedule, you can have great, life-changing generational financial upside potential,
Yeah.
and you get to solve really fun, interesting problems um that are building your business, not someone else's. Like I think it's the best kept secret. And so and I think that more and more people are figuring that out. I think that's why like search is blown up is because people are kind of figuring that out. But I think it's funny how that's still a barrier for some people, especially if you come straight out of business school and you don't have. And I think this is a real thing. If you come straight out of business school and you don't have some big brand name on your resume, there's this fear that you go do a franchise, it doesn't work out, and then your resume looks weak. And if your long-term goal is to like have a successful career in corporate America, that can be a serious consideration, you know. But if you're like me, I don't think I'll ever be able to go back to corporate America. I'm 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 ruined probably. But yeah, if you're like me, then it doesn't really matter.
Yeah. If your goal is to own a business, then the best way to do it is to go own a business, right? It's not to go
Right.
work for
Right.
somebody. Yeah. Yeah. I agree. And it's funny right the people don't realize how much like kind of wealth is created in these small businesses. I have an uncle, it's like a second or a third uncle. I don't know how I'm related to him, right? But I knew this guy and he's always said I got a small flooring business. I never really thought anything of it until I was like probably 20s, like mid-20s when I actually went to his house. And it was like one of the nicest houses I've ever been to. I'm like, what is going on?
Yeah, I was actually on the it's funny, this is I was on a flight a few weeks back, and similar kind of conversation with someone, and she was like investor relations for a big global asset manager, and she was like, "Oh, dog grooming, that's cool." And then she was like trying to make conversation. She's like, "Oh, it's so funny. I have this neighbor who owns McDonald's, and like they are like drive nice cars and have a bunch of houses." And I think it's just funny how people have this perception of if it's a McDonald's, it must be like, uncool, low class. But McDonald's are really great businesses, and there's a lot of really great franchise businesses out there that make for fantastic, lifestyles.
Yeah. And I think too, there's like a dichotomy between, you talked about the different like tiers of ownership in a franchise, right? The kind of person who's a store manager had enough money to invest in the store, but then had to start paying themselves, right? The kind of person who can wait and build and build and build is the kind of person who usually had some success earlier in life, right? So they were a successful person because they can take a bigger bite of the apple and they can go longer without paying themselves. So they must have done something to save up that capital, right? Um, and so I think it also almost self-selects into like if you were successful previously, you're playing in a pool of people who might have been like school teachers, right? And like you're a very savvy business person, or very capable manager, or like whatever your edge was to like kind of create that wealth for yourself. And so like you're more likely to be able to build a bigger business than like the other franchisee down the road who couldn't do that, right? Like they might get there in 10 years or 20 years if they have the drive to. So it's not always apples to apples. And I think people sometimes scoff, right? Like the ego thing, like, oh, I don't want to be a big fish in a small pond. But it's like, dude, that small pond's filled with money, And it's like, why not be the big fish and take all of it?
Mhm.
And so yeah, I think that's another piece for franchising. I think guys who go the search route are attracted to being able to say that I'm searching, but like there's easier money to get, I think, in franchising. Okay. So sorry, we've taken a long time talking about this. I think it's very interesting, your journey, and a lot of people want to be like you, right? They're like, how do I get to 20 units? Right. So that's why I focus on it so much. But I do want to talk about why you started this. It seems like a tech enabled SBA lending platform, right? So like tell us what it is, like give us the name, what it is, um, why you started it, and kind of like what your competitive advantage is.
Sure. So the business is called SBA Source, and it started as an idea about a year ago. So I use SBA loans to finance the first 5 Scenthound locations, and we've since kind of moved to a conventional loan that can finance more than one store at a time. But the first 5 are all SBA loans, and the first store went to a bank that I'd worked with before. It's fairly straightforward. They sort of underwrite your personal financial statement and the brand, and there's not really the baggage of a prior store that to report to the bank. And so for some reason, the first loan is actually usually the easiest. When we went to do the third loan, we went back to the same bank and they said, well, we really want to see the first two operating for longer. We want to see tax returns. And so it started this whole process of me meeting with 3 or 4 SBA lenders, having an intro call. They send a follow up email with a giant checklist of documents they need. And I would spend, 6 weeks back and forth to get to a non binding term sheet. And I felt like I needed to apply with multiple banks because I had this development schedule that I was trying to meet, and I didn't know if any one of the banks was going to do the loan. So, um, SBA Source was born out of that pain, and so what we've built is effectively an online application that you fill out one time, and we shop it out to a network of lenders. And um, specifically, um, you go in, you'll have an intro call. You go in, you fill out the application. It's kind of a TurboTax like intuitive format. You fill out the questions. We package that into a complete package, and we kind of create the mother of all SBA loan packages, which is applicable to any of the SBA lenders that we work with. We'll send out what we call a teaser to the lenders. If they're interested in the deal, they'll get access to the full loan application. Um, Once they have the application, we give them 5 business days to return a term sheet. And so the goal is to get, 4 or 5 term sheets, and these banks are competing for your business. And they know they are. So they're having to put their best term sheet forward. We'll review them with you. And then we'll also give you some of the color behind these lenders. Not all SBA lenders are created equal in terms of like customer service or, flexibility. And so we'll give you the term sheet, and we'll tell you our experience with a bank. You pick a bank, you will then run through their underwriting to closing process. But they now have this big file that makes that process a lot easier. We get paid a referral fee from the lender, so we're able to keep the service free to the borrower, the franchisee, and we get paid the same fee regardless of the bank that you work with. So there's no, incentive to guide you to one bank over the next. So we launched in June of 25, and we have about 150 active loans that we're working. These loans take a long time to close, so we're just now getting loans closing that we started 6 months ago. But yeah, it's been a fun journey.
So is it only franchisees, or are you working with acquisitions too?
So we work with acquisitions as well. We've started intentionally gone to market in the franchise space because there's this one to many phenomenon where you can partner with the franchisor to become a preferred vendor. And anytime they have a new franchisee come in, they introduce them to us. And then we have this kind of steady deal flow. The ETA borrowers, I think it's a lower probability that they do a deal. They'll get an LOI signed and then spend all this time working on the financing, and then the deal doesn't close, and we get paid. Our model is that we only get paid a referral fee from the lender. So, and I think that the SBA lenders that we work with are focused on startup franchises and franchise transactions. And we do have a set of SBA lenders that do ETA style deals, and we're doing more and more of those. But yeah, we kind of wanted to go to market with this focus on franchise.
Yeah. Okay. And more emerging franchises, or all franchises?
We have a wide spread of we've worked with some brands that are, multi-thousand units open, down to we had a call last week with a brand that has not opened their first franchise, and they're just kind of getting started. But I'd say we add value to different franchises for different reasons. If you're like a, sub 100 unit emerging brand, what we can do for you is kind of outsource, partner. Like a lot of these big mature brands have a person that is developing relationships with lenders. If you're a small emerging franchisor, you don't have that person. And so we can help take your brand and go market it to our broad network of lenders and kind of get you in front of banks that you never would have had exposure to. If you're a big brand, then we can create this competitive process that's going to get your franchisees better interest rates, better terms than they would have gotten otherwise. So it's interesting to see um, the value prop and how it changes like for the different people.
Yeah. Yeah. Very cool, man. Very cool. Okay. Well, I appreciate you sharing that. Is as we're kind of wrapping up here, um, what's something that, start if you were everything you know now, but you wake up and it's 5 years ago, right? Like what's the advice you're giving to yourself?
I would say the what we hit on earlier, which is like it just takes longer than you expect it will. It takes longer than your model says it will
Yeah.
to hit the profit numbers that you're expecting to hit to get the team where you want it to be. Like I think um getting the staff, our team in Birmingham, I think at the past 6 months, we finally have like a core team that likes the job, likes the pay, likes their coworkers, and that are here to stay. The first 2 or 3 years, it's like just kind of churning through employees. So I just think everything takes longer than you expect it will. Even
Yeah.
when there's great reception, like even though our revenue kind of took off from the beginning,
Yeah.
it just takes a while to build a good business. Um, I think that's one, and then I do think investing behind an industry that has really attractive long term prospects is it's hard to like overstate the importance of that. I think um that there are lots of franchises that are in industries that the model of the franchise might be working really well right now, but what's it going to be like in 5 or 10 years? And no one knows, but I think we all have like pretty good guesses on, all right, HVAC is not going anywhere. Like people are going to need their unit service. Dog grooming, I don't think is at risk of being disrupted by AI. But I think there's probably a huge category of franchise brands that are like you don't know if it's going to be the it thing in 10 years. And so I think that's a really important consideration.
Yeah. No, I 100% agree, right? And Jeff Bezos said that when he was starting Amazon, he didn't say like what's going to be the new thing in 10 years. He asked what's not going to change in 10 years,
Mhm,
right?
mhm.
And people are going to want things faster and they're going to want things cheaper.
Yeah,
Like, no matter how
yeah,
fast and cheap it is, they're going to
yeah.
want it faster and cheaper, right?
Right, right,
Um, and so that's what he like based the whole growth of Amazon was to get things as fast as possible and cheaper than anywhere else, right?
right.
And I think if you look at it from the same perspective, right, things start to come into focus of like, oh wow, like I want to get into fill in the blank because it's really hot right now. It's like, yeah, well, jazzercise was really hot 20 years ago, right? Like, but who
Mhm.
goes to jazzercise now? Um, and so
You're
I think,
signing 10-year leases typically,
yeah,
like that's a good way to put it too. It's like you're signing a 10-year franchise agreement and a 10-year lease. You
yeah,
feel and also at the end of 10 years, let's say like you also you either continue on with the brand or you sell your business, but the person you sell it to has to believe that the franchise agreement that they're signing is going to be good for another 10 years. So it's like kind of probably should be thinking about it in a 20-year horizon. Do you think this business has legs for 20 years?
yeah. And I mean, if this is like, I think long term thinking really defines business owners, and it's like, is this the thing you want to do until you die or pass it to your kids? I think that's like
Right.
the thing to really ask. And it's like, okay, like, and it doesn't always have to be like, I think robots are going to be cutting grass in 10 years.
Mhm.
Like, well, great, but don't be the guy cutting the grass. Be the guy who owns
Right.
the business that sells, because people don't care whether it's a robot or a person. They just want their grass cut, right?
Right.
And so I think like that's a good way to think about it too. is like you're not going to be like a robot's not going to run the business. Like
Right.
a robot's going to work for you, right?
Mhm.
So yeah. Okay.
I think I read I hate throwing around Warren Buffett quotes, but I think I read like if you if you buy something and run it like it's the only thing you own and like you can't sell it for 100 years, then you probably are running it differently. And that probably applies to like picking a franchise. Like imagine yourself owning this thing and it's the only thing you own, it's the only thing that's going to provide for your family and you can't sell it. Like, would you still want to do it? I think this whole like time it and then flip it and sell it. I think if you go into any sort of business ownership with that mindset, um, it's it may lead you to make the bad decision.
Yeah. Yeah. It's not real estate, right? It's not real estate.
Right. It's not real estate.
Yeah. Yeah. Okay.
It's not a stock you can buy and sell at the click of a button.
Yeah, that's for sure. Okay. Well, very cool, man. I really appreciate it. I feel like I learned a lot. Again, I'm Josh Emison with Tracer Franchising. I help people for free, right? Find great franchises. I educate you on franchising, get to know you, present some brands with research. One of the pieces of research I show is how big is the industry and what's the projected growth rate, right? So like I do take that into account. And then I'll help you through the research process with, one-on-one consulting as well as some technology tools. So you can go to tracerfranchising.com and schedule some time or just email me at josh@tracerfranchising.com. I hope to hear from you. All right. Thanks again, Jacob.
Thanks, Josh. I enjoyed it.
Bye.